The yield in the 10-year went from 0.3 to 1.25 in a matter of days. Without the Fed, this is where we're going. It's not a theory anymore of mine. It's proven. We are going to slingshot higher in rates if the Fed ever gets inflation or steps away from the bond market. Because, Dunnigan, here's the sad truth. And I'm not just picking on the Fed. I'm picking on the ECB, the Bank of Japan, People's Bank of China. I'm picking on and everybody. All right, Bank of England. They own these markets. They are wards of the state now. There is no bond market in Japan. They own it all. Nobody wants to trade it. Only the Bank of Japan buys a 10-year note yielding zero on an insolvent nation with inflation targets of 2%. That's where we're headed. And you think about it, what market has a developed world central bank ever usurped and then was able to hand it back to the people? Never. It's never happened before.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest who has been widely anticipated by our viewers. Michael Pento, the founder of Pento Portfolio Strategies, joins us again this Monday, June 8th, 2020. Michael, thanks for joining us again.
As always, it is my pleasure to be with you, Dunnigan.
Your reputation precedes you. People respect and admire your integrity and the results that you've gained, and frankly, the sanity and the level-headedness that you bring to a world gone mad. We've been faced with just unprecedented situations surrounding us, and frankly, people don't know what to expect next, which way we're going, which way the markets are likely to go, which way their futures and their potential retirement or not is likely to be, pitched into the brink, depending on how things go. So could we take a few minutes for you to just give us an update of your macro perspective of some of the major themes that you see playing out in the economic and financial world today, and then we'll zoom in on some specific themes that come out in the viewers' questions that have been submitted for your visit.
Great format, and again, thank you for having me back on the program. So back around, I would say, late January and February, I started predicting that the data coming out in the ensuing few months will be depressionary. I went on public shows such as yours and predicted that to be the case very soon. And not just a recession. Again, I don't like to use hyperbole. I try to always be as honest as I possibly can when I come on these programs. I predicted that we were headed for a depression. And that actually panned out. We have some of the worst, or if not the worst, economic data we've ever had before. And as a matter of fact, the Atlanta Fed predicts that Q2 GDP will be crumbling at north of 50% seasonally adjusted annualized rate. So I think we could both agree that is a depression. And then last week I said, and I had no idea any advanced knowledge about Friday's non-farm payroll report. But I did say that we're now going to see some of the best economic data that we have ever seen in the world. Some of the best. Because when you fire, 40 million people get laid off, you're going to start to hire these people back. And we've never seen 40 million people get laid off in 11 weeks. And you're going to start seeing millions of people get employed. So continuing jobless claims should be dropping by the millions. But here's the point, Dunnigan, lest you think I'm getting too optimistic about where we are. Unfortunately, we're going from a depression to a very steep recession, but on a second derivative basis, it's getting better. And so here's the problem. People sometimes ask, what's wrong with the gold market? And you say, well, what's wrong with the gold miners right here? So here's the problem. The problem is that as you start getting better data, that's upward pressure on the 10-year Treasury note yield or the longer duration Treasury yield. So that's upward pressure there. But we're not putting upward pressure on the 10-year Treasury from 4% or 5%. We're putting upward pressure from 0.3%. That's where the 10-year Treasury note bottomed. And that is when, Dunnigan, where the Fed was buying, they started buying $75 billion worth of treasuries per diem. Yes, I did not misspeak and put a billion where it should have been million. They were buying $75 billion worth of treasuries per day. If you remember back at the peak of QE, they were buying, 80, 85 billion a month of assets. So they've since attenuated that down. They pared it down to $4 billion a month. So the amount of treasury purchases are going away. Better economic news is coming out. And you have the dissipation of the virus and the reopening up of the economy. That's putting a lot of upward pressure on treasury yields, both nominally and especially in real terms. That is putting a little bit of a ceiling and some pressure on the price of gold right now. But please be assured this is only a temporary phenomenon. I predicted it. I pared back some of my gold exposure, looking for a chance to get back in because I believe perhaps this is my fear in the fall. There's some events. There's a confluence of events that could really hurt the trajectory of treasury bonds. So the treasury yields could fall, right, and prices could rise. And that is, well, there could be a Democratic sweep of, not to get political, but Wall Street will not like a sweep out of Republicans, especially if the Senate goes Democratic, because then you're going to have corporate taxes going up. Okay, that's what Joe Biden wants to happen. There should be, unfortunately, a resurgence of the virus in the fall as well. Unfortunately, I say, if you look at globally speaking, if you look at Johns Hopkins University, the number of cases is per day is at an all-time high. A number of new virus cases. So if you look what's going on in Brazil. So globally speaking, not New York, not New Jersey, not America. Talking about globally. So that could happen. And here's the kicker, though, also, in the confluence of events. And I'm sorry I might be taking a lot of time to answer your very important first question, but I promise I'll wrap it up here in a second. You also have, what's happening now is all of the stimulus is starting to wear off. That's going to start happening in July. So if you think about in July, the extra $600 to pay people not to go back to work in the CARES package wears off. That $1,200 that they gave every man, woman, and child who doesn't make above $400,000, that starts to wear off. The payroll protection program, that money sent to the small business, that begins to be worn down. So you have a confluence of events in the fall which could really boost the price of gold and bring some sanity back into the stock market, which, and I'll end it with this, is now blown away any other historic valuation we have ever had since the dawn of the signing of the Buttonwood Agreement. Okay? The value of stocks today as a proportion of the underlying economy, which is the only real metric, this is the primary metric that makes all the difference in the world, has never been more expensive.
You mentioned there about the 40 million layoffs being one of the things, and the sharp drop in valuations of equity markets being evidence of a depression. And even if some of those people are getting hired back, a lot of those businesses, small businesses in particular, were driven out of business. How does that get us back? How do you see a bounce back? One of the questions, and I meant to get to this, was do you see a V-shaped or a U-shaped or a L-shaped recovery? So take us out a little bit farther down that timeline.
Yeah. So, I wrote a commentary maybe 2 months ago that, forget about the V-shaped recovery because the right side of the V is going to need Viagra. It'll be a flaccid recovery. And, you see a sharp rebound in the short term. It will be a V for a very, very truncated period of time, and then you'll start seeing tailing off. Precisely why you touched on the main issue here is balance sheets have been impaired and damaged, and some of them beyond repair, unfortunately. So these businesses that you have a restaurant that was forced to close for 3 months, you gave them some PPP loans, and they were required to use most of that money to pay rent and pay employees. That money gets exhausted, and then they haven't made money for 3 months, and then they're told when they reopen they have to put some special partitions up and only allow 50%, between 30 and 50% occupancy. Well, Dunnigan's restaurants are insolvent under that rubric. You cannot make money in that environment. So you have a wave of bankruptcies in the future, and you even see some municipalities in the same function. So what I'm trying to say is the underlying economy has suffered a serious wound, which will leave a deep scar, but it's not being at all reflected in the stock market. And you have to ask why. Okay, so the great balance sheet expansion from the Federal Reserve. So you think about the start of the Great Recession, which was December 2007. 7 years hence from that moment, that was called the great and unique and temporary expansion of the Fed's balance sheet. And that was $3.7 trillion over 7 years. In the last 10 months, because the Fed's balance sheet started to rise in September of 2019, it wasn't because of the Wuhan virus. It kind of like started to trickle up, and then boom, there's a rocket ship up. $3.5 trillion. So it took in this unique and unprecedented expansion of central bank money printing 7 years. We've done 7 years in 10 months. And even if there was no economy, this is like one big grand casino game that we're all playing. Hey, the sovereign, the assets that exist from the primary dealers, sovereign debt, corporate debt, collateralized loan obligations, all of these assets that sit on the balance sheet of banks, they're being taken away by the central bank. And then what do these gamblers on Wall Street do? They buy more. They buy more sovereign bonds. And why not? Why not buy more CLOs? Why not speculate more in high yield junk debt, Donegan? Why not do that? Because, why wouldn't you not just front run the next wave of central bank money printing? So that's all that's going on here. I mean, the reality is that there was a lot of people hurting in America, and the divergence between the very wealthy and the poor was, amazingly wide before the Wuhan virus. And that divide has gotten exponentially more wider.
Wanted to take the opportunity to leverage one of the things you just mentioned about the expansion of the currency supply, because there's several questions. This is one of the major themes in the questions that have been submitted by viewers. Here's two that are in the same vein. Heike Frost asks, Michael, do you agree that even though the Fed continues to print unimaginable amounts of fiat dollars, inflation or hyperinflation won't be an issue until we get money velocity? It appears the virus has kept money velocity at a standstill as most have been staying at home. Once states and cities begin going back to work, do you think money velocity picks up to a point where inflation becomes recognizable? And similarly, Captain Birdseye says, has Michael considered the possibility that COVID has been a slowdown of the money velocity in the currency to an attempt to prevent hyperinflation due to the banks issuing massive currency out of thin air?
So in the equation of exchange, NV equals PQ, and I'm sure I don't want to bore your audience with the equation of exchange. So basically, my view is that velocity moves with GDP. So as you exchange money for goods and services, GDP increases. So I'm not so much concentrated on the velocity, although that's very important. I don't want to just dismiss that. What I focus on, and this is what inflation really is. It is not, people say, well, it's an increase in the money supply. Well, what money supply, Donegan? Is it the supply of base money? Because we had a huge increase in the supply of base money. It went from $800 billion to $4.5 trillion under that great central bank balance sheet expansion I just talked about. And look at around the world, we had $26 trillion of central bank counterfeiting since the Great Recession. Nothing has ever been seen like that before. And, where's the hyperinflation other than Wall Street? Where's the hyperinflation in Japan? So here's what inflation really is. It is about psychology. It is about the market deeming that your paper currency is losing value and will continue to lose its purchasing power. That is what inflation is. And that comes about from many reasons. Just think of a thought experiment. If we just had the entire US military wiped out, but we didn't print a dollar, no central bank expansion, but the entire U.S. military was wiped out, the faith in the purchasing power of the dollar would be eroded. That's one example. Many times, Zimbabwe, Weimar Germany, Hungary, it is when, in Venezuela, it is when you print too much of your currency, and then you start losing faith in its purchasing power. So, it's a debt explosion where you have a massive amount of debt outstanding, and then you can't afford the interest on the debt. Nobody wants your debt because you have a closed currency, and you have nobody wants to own your bonds. I'm talking about isolated banana republics. And then you have a currency collapse and a bond market collapse. And the only buyer of that debt is your central bank. So that's another hyperinflationary scenario. So the question is, do I see hyperinflation? I don't see hyperinflation in the future, not in the immediate future at all. What I do see is stagflation coming, and stagflation is going to come from that erosion in the purchasing power's faith from the market. And if you keep doing these iterations of helicopter money, and I think we will have to have many iterations, because like I just said before, I was alluding to the fact that once the government opens up and people are allowed out, and there is a resurgence in this virus, and you can't, hotels and airlines and restaurants, the whole food industry, lodging industry, or leisure and hospitality is the sector that I'm referring to, they can't open up fully. So then you're going to have to give these people some form of universal basic income. And we already, jumped that shark. We're already, that was a theory of mine and some others, and that this is where the central bank wanted to take us. Well, we got there pretty quickly. So if the economy doesn't recover, and I don't think it will, you start sending people money, and they're fallow. They're unproductive people. This is the key. They're not expanding the amount of goods and service available for purchase. That could bring you a stagflationary scenario. Why don't I think hyperinflation is coming in the near future? Because there's one necessary ingredient for hyperinflation. You need a currency collapse. Every hyperinflation in history had that aspect to it. It was a currency collapse. In other words, you have to ask yourself the question, can the US dollar collapse vis-a-vis the euro? I don't think so. Against the yen, I don't think so, because everybody's doing the same thing. It could happen sometime in the future. Yeah, anything can happen. But in the foreseeable future, not a high likelihood. So then you're just left with what could happen, like what happened in Rome, where you have one primary currency that undergoes the erosion of its purchasing power confidence. So could you end up with 1,000% inflation? Not technically hyperinflation. Could you end up with double-digit inflation? That's the real problem, because when the United States gets double-digit inflation, or even the euro or the yen or any currency in the developed world, once you get that, then the real crash, I call it the genuine depression or the greater depression, begins. Because once you get inflation, which is what all these central banks want, by the way, Don, again, they all want one thing. They all want 2% inflation the way they measure it, okay? And if you get in 2% the way they measure, which is core PCE deflator, you're talking about mid to upper single digits at a minimum. Once the market catches on that these monkeys have created inflation, then you start to see bond yields rise, but they're not going to rise from 5%, 6%. They're going to slingshot higher from where they are today. So, the Japanese 10-year is basically zero. Europe is not much better. We're at 0.8% here on a 10-year note. You get 2% inflation, and now you have an insolvent government that is borrowing massive amount of money that has inflation. And the central bank is faced with the dilemma of having to either increase its monetization of debt, which increases the rate of inflation, or steps away from that. And then the primary buyer of a 10-year note yielding 0.8% steps away. And my God, either way you look at it, the slingshot in yields is going to be devastating to the economy and to asset prices. Because the only thing holding this artificial edifice, the construct of a mega asset bubble in equities. The only thing, Dunnigan, that's keeping it with any semblance of solvency is the fact that borrowing costs are almost zero. If that ends, watch out. When that ends, watch out. Not if, when.
Interesting. You just answered, I believe, Victory CSA's question after this setup. It says, which comes first, rising interest rates or hyperinflation? And it sounds like you're looking at rising interest rates being the big danger ahead.
100%. So if you look what happened so let's just go back to what happened in March, Dunnigan. So the 10-year Treasury note hit an unbelievable, incredibly low yield of 0.3% on the 10-year note. And then, and this was before the Fed started printing any money at all to buy treasuries, the MOVE index, which is the volatility index on treasuries notes, soared. It blew up. I don't know if you know what that is, but don't worry about it. Even if your audience doesn't know what it is. It's basically saying, like the VIX index for stocks. It's basically saying, oh my God, we've got a really serious problem here, which is one of the reasons why I went net short in the portfolio at that time, and since covered, and thank God doing very well. But the yield in the 10-year went from 0.3 to 1.25 in a matter of days. Without the Fed, this is where we're going. It's not a theory anymore of mine. It's proven. We are going to slingshot higher in rates if the Fed ever gets inflation or steps away from the bond market. Because, Dunnigan, here's the sad truth. And I'm not just picking on the Fed. I'm picking on the ECB, the Bank of Japan, People's Bank of China. I'm picking on and everybody. All right, Bank of England. They own these markets. They are wards of the state now. There is no bond market in Japan. They own it all. Nobody wants to trade it. Only the Bank of Japan buys a 10-year note yielding zero on an insolvent nation with inflation targets of 2%. That's where we're headed. And you think about it, you know, what market has a developed world central bank ever usurped and then was able to hand it back to the people? Never. It's never happened before. We even proved it last year, and I mentioned this before, but it's bearing in mind to mention again. We started, do you remember in 2019 when the repo market blew up?
Mid-September.
In the summer of 2019? Yeah. What was that all about? That wasn't about a virus. It was about what? The Fed was tapering its asset purchase in 2018. We're not going to sell these assets any longer. We will start buying them. Wasn't done quickly enough. The free market said, hey, we've got a problem with junk bonds and CLOs. These are insolvent. We need the Fed to buy them, but there was no QE at the time. And then everything, the poop hit the fan. That's what the repo market was all about. And you had the double-digit spike in yields on the repo market when the target rate was 2.5. So it's not. Don't be. Please, I want to make sure your audience understands. The Wuhan virus expedited what was happening anyway. We would be here anyway. But now what you see, here's the real problem, Dunnigan, is if I didn't give you enough problems to worry about at all. What happens when the Fed usurps markets and takes interest rates to zero? It compels people and corporations and governments to take on more debt. And that's exactly what we're doing. Our national deficit, the annual deficit, is $4 trillion. $4 trillion in 1 year. We went to $26 trillion national debt. Corporations are piling on debt like they've never done before. I think this year they're on pace to increase the outstanding debt by a third. Think about that. And zombie companies, which were feeding off of low interest rates, were all going to go bankrupt when we had that spike in interest rates. And now they're issuing debt willy-nilly. In fact, Amazon, which is not a zombie corporation, but it is a corporation, right? I mean, it is a tech corporation, which is subject to going down 50% in its valuation throughout its history. It happened twice already. They issued a bond, investment grade bond, at 0.4% for a long-term bond. I mean, who is giving corporations money at less than 0.5% going out in time? 10 years.
In addition to those corporate bond flurry right now, there's also a flurry of additional stock offerings by companies. It's like there's open season now. Get it quick while it's good, because the Fed's out there just flooding everybody with liquidity. So, what do you see happening? People want to. Our viewers want to make prudent decisions for themselves, and it's becoming more and more difficult to do that because we're living in this time where it seems like taking on additional risk and taking on additional leverage is what's being subsidized, what's being protected by the powers that be. So, what do you see happening on the corporate front going ahead if this kind of rampant expansion of them trying to not only get money from selling bonds, but also from selling their stock is happening at this time in the zombie company curve you talked about?
Dunnigan, the bubble that was unsustainable prior to 2020 is just getting unimaginably bigger. It's growing exponentially. This bubble in everything, bubble in stock prices, bubble in corporate debt. Individuals are taking on more debt too. I know the savings rate. They say the savings rate is going up, but we have a record high amount of household debt, and the only thing that's keeping us going is these very low, ultra low, unsustainably low interest rates. So unfortunately, I think what's going to happen is that if the economy does slow down again in the fall, which I predict it will, because of the confluence of those events that I predicted, as after this fiscal stimulus starts to wear off, you're going to have the Fed come back in the ballgame here again and buy even more corporate bonds. You know, they haven't really even got some of these primary lending facilities off the ground. Remember, the Fed went into they're buying junk bond ETFs, and they're making this is when I said they jumped the shark. The Fed is making primary loans to corporations. This is something that never happened before, and that program is set to get off the ground very shortly. So they're going to be expanding the money supply. Talk about one of those other questions that we addressed earlier as to why I think we're going to have stagflation. It's because now the Fed is making primary loans to corporations, getting the broader monetary aggregates, not just base money supply, broader monetary aggregates to expand. Look at the shocking advance in M2. And it's just mind-boggling. And that's going to happen over and over again. And as they keep building this inflation bomb, they keep on building this hydrogen inflation bomb, it's going to go off. And I don't think, I really don't see it. And I get a lot of things, wrong in my life. I get a lot of things right in my life. I just can't, I don't think they've thought this through, Dunnigan. When they achieve inflation, I think central banks believe, well, we could just easily take it away. We could just, stop buying bonds and draw down our balance sheet. How far did that last in Japan? They didn't even try it. How did that go in Europe? I think they stopped for a couple of months and went right back into QE, and it didn't even work here. So what makes them think when the bubble gets much, much bigger and asset prices get much more distorted and interest rates are pushed further down into the sub-basement of history, is that a good time to normalize interest rate? I don't think so. It's not going to work.
Well, you've been talking about this buy-up of everything by the central banks leads into I think what'll have to be our final question, or we'll have one more after this, from H. Paul Fuchs, who says, do you agree with Greg Manarino that the more debt the Fed issues, the more money it prints, the stronger it gets until it will own and control the whole planet?
Well, I don't know if it's strong. I mean, the more power it has, I don't think it gets stronger. The more debt outstanding, the more the debt needs. This is just, common sense. The more debt outstanding you have, the lower interest rates have to be. But the more debt outstanding, the higher interest rates should be. So how you square that circle is you have the Fed come and purchase everything. That's what, they're usurping markets. I don't know if that means they get stronger, they get more influential, they become more important, but you've weakened the country. A strong central bank is one that has a very small balance sheet with lots of dry powder, that has the free market functioning. That's a strong central bank that has plenty of room to intervene if it must. This central bank is weakening the economy and usurping and vanquishing markets, which makes it extremely vulnerable, in my opinion.
Meaning that it has fewer options at its disposal, and it has kind of painted itself into a corner. But on the other hand, it does own everything.
Yeah, yeah, yeah. It owns everything except stocks. That's coming next, I believe. Janet Yellen already tried to clear the way for that. Ex-chair Yellen wants Congress to give them approval. But we what have we learned? That the Fed, you have a constitution, and you have rules that govern the Fed. But in a crisis, both those things are fungible, and they're thrown into the toilet. That's been proven over and over again, unfortunately.
Last question from Bern Brown. Since it's obvious the Fed will continue to underlie this market, does this mean another 8 years of sideways movement for gold? If all the money is going to chase the Fed, it seems like, and because of this, gold seems like it could get sidelined as it has been before.
Well, you say sidelines. I mean, gold had a massive run up until 2008. It fell off in the fall of 2008. Then a great run from 2009 all the way to 2012. So I mean, it wasn't sidelined the whole time. It did get sidelined because what happened? Because, well, real interest rates started to rise a little bit in the United States, and the deficit plunged. I mean, we had 1.2, 1.4, 1.4 trillion dollar deficits at the height of the Great Recession. They came all the way down to 600 billion. So if that happens again, then maybe we could have gold sideline. I just don't predict that. I don't think that's going to be the case. I think that, as you said very correctly, the Fed now owns these markets. We hadn't, even though it wasn't completely free, we had a much freer market in the wake of the Great Recession. Where are we now? I mean, the Fed was able to take rates from 0% to 2.5% in the wake of the Great Recession. Are they going to be able to do that today? What would happen to the real estate market? What would happen to the stock market? What would happen to the junk bond market? So I think, just like Japan, they're stuck at zero. Once that gets inculcated into the psyche of people, that we're going to have to, this one, remember, back in the wake of the Great Recession, that was a one-time event in which the Fed was going to drain its balance sheet from $4.5 trillion back down to around $2 trillion. That never made it. So people should be aware now. This is not unique, and this is not a one-time event. They now own these markets. Don't expect the balance sheet to ever go down. Don't expect them to ever normalize interest rates willingly. That's why I think you're going to have much more support for the gold market this time around, in addition to the helicopter money and UBI, this time around than we had in 2008 to 2012 to 2016.
If we had more time, I was wanting to get into talking about people looking forward to their pension plans, their retirements, that sort of thing, retirement accounts. I don't know if you have just 5 more minutes to try to give us your perspective on that.
Go ahead. You ask the last question.
You mentioned a lot of big bubbles. Well, another big bubble we've had is the baby boomer population demographic bubble, and they're approaching or entering retirement in record numbers over the next decade. That's another dynamic that's going to be playing into is a lot of people wanting to know that they have a financial future. What is the real prospects for people who want to do what they can within these forces that they can't control, to do what they can that's within their control to make sure that they do have a viable financial future?
Well, pension plans that were already enormously underfunded going into the virus are now have a 20% funding ratio. So their assets divided by their liabilities is about 20%. In many cases, Illinois, New Jersey, I think is 25 or 30%. So these are bankrupt institutions that are going to rely on central bank activity. So when you say what should the regular person do, the small person do, I mean, of course you say you want to buy some physical. You should always start buying 5% of your assets into physical gold. If you have a little more money, and by the way, when I say physical gold, I mean gold that's in your possession. I don't mean paper gold. I mean, you take that gold and put it somewhere that you can get it without a third party telling you, you want to call Hong Kong and say, hey, I have my bullion in your vault over there. Can I have it? That's not going to work. So 5% of your liquid net worth should be in physical bullion. And then if you have some more money, I have a $100,000 minimum for my portfolio. I have the inflation, deflation, and economic cycle portfolio. So what I do is I try to time these purchases according to what cycle the market is in. Are we deflating? Are we recessing? Are we going into a depression? Or are we hyperinflating, stagflating? Are we growing? So if you know what sector the economy's in or headed into, then you could best allocate your portfolio. Do you want to overweight bonds? Do you want to have utilities and bond proxies in your portfolio? Well, maybe you do when we have a recession or deflation. But do you want to own those things in hyperinflation or intractable inflation? I don't think so. So what sectors, what style factors to own, when to own gold? What's the direction of real interest rates? Well, they were headed lower a while back, capitalized on that. Now they're headed higher in the very short truncated cycle that we're in. That is giving a pause for gold. But on the other end of that, I expect real rates to fall profoundly negative, more negative than they've ever been in history, as the Fed pushes the entire yield curve. We're going to find out something on Wednesday, Don, again, real quick. We have a Fed meeting, right? There's something out there called yield curve control. I think the Fed might want to see the short end near zero and the long end near 1. And no matter what happens with inflation, 2, 3, 4%, remember, the Fed wants inflation to go above 2% to make up for all those years that it was below 2%, the way they measure it. Well, lately it's been, zero, nothing. So they might be overjoyed. Well, overjoyed if inflation goes to 4%. Well, if the Treasury yield curve is 0 to 1 and inflation is 4, then that's going to be a record low negative real yield, which is rocket fuel for gold. So, that's the kind of stuff I look at, and that's how you make money in this market. Even though, by the way, I'll say one thing before I let you conclude the interview, is that you cannot be a passive investor any longer. You're going to get run over. You have your head chopped off. You have to be an active investor. And it doesn't have to do with me. I'm not self-serving for me to say, come with me, but do not just give your money to a 60-40 portfolio, because that ballast of bonds, say it was 60% stocks, 40% bonds, that made sense when bonds were 6%, 4%, or even higher. It doesn't make sense when the 10-year note is 0.8%, because even if those yields go to 0, then you might make mid-single digits return on that. That's not going to offset what caused the yield to go to 0, which means that 60% of your portfolio is going to be down 40 to 50%. So you have to be an active manager and be smart.
We've been speaking with Michael Pento, the founder of Pento Portfolio Strategies, and he's got contact information, how people reach you.
So the website is pentoport.com. You can have a free 5-week trial of my podcast, gives you an overall view of my thoughts. It's only $49.99 per year, so it's a great way to get, you're not going to hear stuff like you hear on your channel on CNBS any longer. They just don't want it. They don't want the truth out there any longer. So if you want to get the truth, you'll get it from people like me and obviously from your channel coming on programs like this. That's $49.99 per year. It's a great value. If you don't like the trial, it's a free trial. And of course, like I said, if you have around $100,000 to invest, I'll take you and take care of you personally myself as a client.
The other thing I was going to mention is that we're having John Williams from shadowstats.com on later this week and going to shed the light on some of these. You keep talking about the way they measure it, consumer price index and that sort of thing. So we're going to pull back the covers on that and get people spread some of that awareness that people are aware of what's really being done.
Tell John Williams that Michael Pento wants to know what happens if you included home values, not owner's equivalent rent. What happens if you included stock prices in that formula? That's, by the way, that's one of the reasons why we're seeing so many riots, because disenfranchised people, Don, again, you have a huge wealth gap created between the renters and the people who are laid off at McDonald's and Walmart and the people that are on Wall Street. It's very unfair. And that's what's causing a lot of angst, undercurrent of divergence in income in this country, and it's getting wider.
Very concerned about that and about this instability that brings to our civil society. Thanks, Michael Pento from Pento Portfolio Strategies, for joining us again this time on Liberty and Finance.
And God bless you with much success. I know you're getting a lot more viewers, and keep up the good work, Duncan.
Thank you, Michael. If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.